Last week, I lost several $100s in literally just 2 back-to-back days. But I'm even more bullish than ever. So the healthcare sector has been getting battered recently, and just about every stock is down, including two that I personally own, United Healthcare and Novo Nordisk. Today, we'll talk about my thoughts on them post earnings, as well as running some DCF models to see potential returns. Starting with my larger position of the two, United Health Group, I currently have about $1,200 in them, and it makes up about 7% of my primary dividend growth portfolio. There's a lot you may like about United Healthcare. They're a recession resilient healthcare giant with growing cash flows and years of consecutive dividend growth. In 2024, they had a cybersecurity attack that caused their net income to drop. And since then, they've mispriced their plans, which is part of the reason for their drop in price. Their DOJ investigation has also been a big factor in their drop in share price, which has led to a personal loss of over $300 on the stock so far. But despite that, I'm even more bullish now than I was previously. Deep Value Stocks on YouTube made a video where he compared United Healthcare to Meta and Wells Fargo, and both Meta and Wells Fargo had major DOJ investigations, which honestly isn't that uncommon when you're the big dog at the playground. Both of their share prices dropped a lot, and Wells Fargo was proven to be, actually proven to be committing major fraud. And as of now, both of those stocks are at or near all-time highs. Something else he highlights that I really like is Trump is trying to lower the cost of medications. If you get the president on your side, there's pretty much no way you can lose. But if you can lower the cost of prescription drugs, it'll cost United Healthcare less out of pocket and allow them to generate even more in free cash flow. Aside from this, I'm not sure if the population has been getting healthier, but we have been living longer. Just look at Brian Johnson. If we're living longer as a society, we will require more insurance for a longer amount of time. I just want to take a second to look at their earnings real quick. I'll look at a few bullet points and then we can look at some of their actual fundamental stats. But Qualtrim summarizes earnings reports, and if we kind of just skim through this, we can see the primary driver of the 2025 earnings shortfall is underestimating medical cost trends, an extra $6.5 billion in cost versus planned. If we scroll down, it says their 2026 pricing is focused on margin recovery in all core areas, and they serve 600,000 plus members. Optum performance, they were about $6.6 billion below plan, with the majority of their shortfall from value-based care due to enrollment mix, medical trend acceleration, and misestimation / execution around the new V28 risk model. If we look at their financial performance, their revenues were up $112 billion, which is actually really good, but their EPS was down due to, again, the mispricing issues, but their top line is still growing, which is good. Their full year adjusted EPS guidance is set at least $16. Their revenues projected near $448 billion, which is 11% growth. Medical care ratio revised upward to 89.25 due to higher medical costs. Cash flow from operations expected to be about $16 billion. Dividend increased by 5%. That's really not that good, but it's okay. They're still growing. It's still faster than inflation, and they're going through some hard times right now. 2026 expected to show solid but moderate earnings growth with faster recovery in 2027 and beyond. I think I talked about this in my last video. They're expecting misses on their next couple of earnings, but 2026 they're expecting to beat. But even with that, they don't expect to do that good. But 2027, apparently, they think they'll get a lot better and a lot faster in terms of their growth and basically be back on track to where they were before this whole thing went down. Medicare Advantage margins are targeted at 2.4%, with progress expected toward the midpoint by 2027. Commercial margin targets remain at 7 to 9%, while Medicaid non-dual may run at a loss in 2026, but aims for a 2% long-term target. Differences in recovery and margin potential exist across Medicare populations. AI is well, I guess I should finish this, exists across Medicare populations with facing the most acute near-term pressure, but also being more addressable through annual repricing. AI is a strategic priority across all business units, being deployed in auditing, payment integrity, service operations, and analytics, both as a cost tool and for product innovation. Pipeline includes new AI-powered revenue cycle and coordination of benefit solutions, highlighting a move towards more tech-enabled, integrated healthcare services. The company reaffirmed its commitment to building a broad and deep set of care capabilities to enable value-based care, home health, behavioral, surgical centers, and specialty care. Assets like pending amid I can't pronounce this, amidices, or I don't know how to pronounce it. I'm terrible at this. But this acquisition are considered foundational to its strategy of delivering holistic, integrated care. I swear I realized it was Amidices after I recorded. I just didn't feel like re-recording. If we move over to their financial metrics, they're still making money. Their total revenue is up 14% year over year in the most recent quarter. People served has been declining over the past few quarters, but again, this basically just stems from the recent money problems. They've had to drop certain markets they think will result in heavy losses. Their net income has been rising year after year, aside from the cybersecurity attack. They continue to buy back shares, and they've actually spent more on buybacks in the last 3 years than they have on paying dividends. Their gross margin doesn't look so pretty, but if we look at their operating and profit margins, not only is it generally pretty stable, but for the most part, it's been steadily rising over the past 10 years. If we look at their PE ratio over the last 10 years, it is significantly lower than its average at about 10.5. You don't want to look at this in isolation. If we also look at their free cash flow yield, which is a metric I really like, we can see that it is a little over 9%, which means that for every $100 we put in, we're getting $9 in free cash flow. Typically, a higher free cash flow yield is an undervaluation signal, and I don't really care too much about price to sales, but it's basically saying the same thing. All three of these metrics are pointing to undervaluation. So Qualtrim has a built-in DCF calculator, and it also includes a 5-year projection, which I think is pretty cool. But if we take their earnings per share and their average PE ratio, which over the past 10 years is somewhere around 22, 23, I just put in 23, and then we take their growth rate, we can see this. Over the past 10 years, if we exclude the 2024 outlier because of the cybersecurity attack, it was 14.78%. And we want at least a 15% return per year, ideally. According to the rule of 72, if we can average that over 5 years, we'll double our investment. But if we want to get a 15% return, we need to buy in at least $523 a share. But from today's price, we can see an average of 33% per year over the next 5 years. Now, this is honestly kind of ridiculous. I don't think this takes into account a lot of stuff. I guess really the slowness of the coming quarters, and I think their overall growth is just going to be a little bit slower for a time. If we include the cybersecurity attack, it was 9.9%. I don't know why I put 9.7 here. I wasn't paying attention. But if we want to get a 15% return, we got to get in at $419 a share. And if we do from today's price, we'll average 27%. Again, that's still ridiculous. So let's go lower than this. Let's be a little bit conservative. I put in 7.5% growth rate. And even still, from today's price, we get basically 25% growth on average over the next 5 years. That is phenomenal. Now, okay, maybe that was a little bit of cherry picking. Maybe their PE doesn't go back to their average. Let's say it only goes up to 12. To get a 15% return, we would have to get in at $197, and $198 was actually somebody's price target. I don't know who it was, but it may be possible. I'm not betting on it, but anyways, if we bought in from today's price, we would average 9.7%, which still isn't that bad. If it only stays around 10, it looks terrible. We would only average 5% a year. That's really not that good, but I just don't see that happening. 12, if it only goes up to 12, 9.7% isn't that bad, and then pretty much anything above that is just really good returns. A couple things I want to highlight real quick. Their return on invested capital is 12.8. Typically, I like to shoot for higher than this, but really with any company, as long as it's hitting at least 10, that's a pretty good sign. And they've had really, really heavy insider buying recently. Dividendology pointed this out. In the most recent quarter, they had more insider buying than the past 15 years combined. And I remember when I did research for my Roaring Kitty video, he talked about insider buying, and sometimes he said sometimes he might even buy just based off that when there's so much clustered insider buying. I'm looking at Open Insider right now, and back in on May 16th, the CEO bought $25 million worth of shares, and the CFO bought $5 million worth of shares on the exact same day. Before that, the couple of the directors were buying a bunch of shares. There's been so much insider buying on this stock recently. And then we have Novo Nordisk. Now, from a geopolitical standpoint, I'm not as bullish on them as I am with UNH, just because if Trump does lower the prescription drugs, that would hurt their sales a bit, but regardless, they're a phenomenal company, and I think they're going to outperform once the healthcare sector gets out of this slump. And honestly, aside from that, I don't think it really matters that much. At least when we think about their competitors, let's take Eli Lilly, for example. They're probably Novo's biggest competitor. They're going to be negatively affected as well, so it's not like Novo is going to be left behind. But anyways, we'll take a look at some of their stats, and then I'll get into their earnings report. Right off the bat, this is one of the companies I love to see. Steady revenue growth, steady net income growth. Free cash flow doesn't look that pretty from a quarterly standpoint, but if we zoom out to the annual chart, we can see pretty steady free cash flow per share growth as well. They do have some stock-based comps, and it brings down the free cash flow per share by 8 cents. I'm really not that worried about it. If we look at their dividend chart, this honestly confuses me a bit because other companies have steady growth on their chart, but I know that Novo Nordisk grows their dividends, so I think this just represents starting yield. But anyways, they have a lot of debt right now. I'm not really too worried about that because assuming I did this calculation right, I subtracted their cash from their debt and then divided by EBITDA, I got a net debt to EBITDA of 1.18. Anything below 3 is generally considered good, and this basically means that they can pay off their entire debt in just a little bit over a year. They have consistently growing research and development, which I like. Novo Nordisk is a constant innovator, and this will help them stay ahead. They continuously buy back shares. They have steady margins across the board, and all three valuation metrics basically point to undervaluation, just like United Healthcare. Their free cash flow yield right now is around 5%, and their return on invested capital is a tremendous 40%. When it comes to their stat sheet, Novo Nordisk is a powerhouse. So we're just going to kind of skim through their earnings like we did with United Healthcare. Now, this first section really doesn't look that good, but it does get better. They achieved 18% sales growth and 29% operating profit growth in the first half of 2025. That's really good, but considering their lowered expectations, that likely means the back half of 25 will see a lot worse growth and profit. Lowered full year 2025 outlook due to lower growth expectations for Wegovy and Ozempic in the U.S. and Wegovy in certain international markets. Their gross margins also decreased from 84.9% to 83.4%. Their sales and distribution costs increased as well by 15%, mainly due to promotional activities. Their R&D costs fell by 11%, owing to impairment losses from the prior year. Free cash flow dropped as well, driven by higher CapEx. Interim dividend was raised by 7%. That's good. Updated 2025 guidance. Sales growth now expected at 8 to 14%. Operating profit growth at 10 to 16%, both at constant exchange rates. If we scroll down a bit, this is where it starts to get better. So their total sales were up 18%, but their U.S. operations specifically was up 17%. International operations up 19%. GLP-1 diabetes sales grew 10% globally, 9% in the U.S., 10% in international. Wegovy sales rose 37%. Wegovy prescriptions via NovoCare Pharmacy account for 10% of total initiatives ongoing to expand direct-to-patient and telehealth channels. CVS National Template Formulary now covers only Wegovy for obesity, showing early signs of positive prescription impact. If you watched my last video, you'll know that was one of the things that we had to we were wanting to look for. So that is a very good sign. That was one of the critical metrics. Obesity care sales in international operations grew 125%. Wegovy alone posted 335% growth across international operations regions with launches in 35 countries, including 15 new ones in 2025. Their Novo Nordisk GLP-1 product command 71% volume market share in international operations. Rare disease sales, I can't talk right now, up 15% globally. Strong performance following manufacturing improvements. If you watched my first video on Novo Nordisk, you'll know that obesity stuff is their primary thing, but they are wanting to expand into rare diseases. I think Alzheimer's was one of them. And rare disease sales up. That's a really good sign. That's showing that they're not just one thing. They're diversifying a bit and becoming an even stronger company. Nearly 46 million patients treated globally. 900 million people live with obesity worldwide. Less than 1% are treated with branded anti-obesity medications. And that actually brings me up here. I think I forgot to mention this. Estimated 1 million patients using the compounded GLP-1s. We talked about this in the last video. There's a bunch of knockoffs, basically, but the FDA has since been cracking down on this. If we come back down, only 7% of the global diabetes prescriptions are GLP-1s, so they're focusing on expanding their market reach. Ozempic received positive opinion from EMA for peripheral arterial disease in T2D. Slower growth in China due to inventory destocking and timing, not due to market share loss. That is key. Market share is still increasing. Optimism about long-term growth in China driven by high prevalence and unmet need. If we scroll down a bit further, it says significant capacity expansions underway. CapEx is at or near its peak with gradual decline expected as major buildouts conclude. Guidance constructed to accommodate forecasting uncertainty, especially U.S. gross to net impacts and potential market volatility. Reaffirmation of commitment to market expansion, innovation, execution, and addressing unmet patient needs, particularly in diabetes and obesity. Focus on driving growth by deepening penetration, existing and new markets, continuing strong commercial execution, and leveraging the pipeline and innovative portfolio. It's hard to put an average on Novo's PE because over the last 5 to 10 years, it's been increasing in line with their price. But if I zoom out to 1985, it was often around 14 to 15, and if we go back to the past 10 years and account for their recent explosive growth, I think assuming a PE ratio of 18 is reasonable. Their EPS over the last 10 years has averaged 12.8% growth per year, and we can see that if we want to average 15%, we would have to get in at $59, and if we got in right now, assuming these metrics, we would average an 18.6% return. You always want to be conservative in these metrics, so what if EPS went down to only 9% and PE went down to 14? Well, if we wanted a 15% return, we would have to get in at $39, and that's really low, but it was just at 40 a few days ago. If we got in right now, assuming those metrics, we would average 9% growth over the next 5 years. Now, with that in mind, what if the PE follows their price again and shoots up? It was just at 40 before the dip, but what if it hits 22? And what if the obesity rate does grow an average of 30% a year, like Dividendology says, and that brings their EPS up as well? EPS at 10% would average a 20% return from today's price, and at 14%, which is the current, it would average close to 25% a year over the next 5 years. So monstrous growth potential with both of these companies. But let me know your thoughts. Did you like me going over the earnings? Are you buying any of these companies? I know Daniel's vids just said he sold out of UNH, so that's like a completely opposing opinion to me. But we'll see. We'll see what happens. I just wanted to share my thoughts. If you stuck around till this long, thank you so much. I really appreciate it. If you got anything out of this video, I hope you did. But if you did, consider leaving a comment. Consider subscribing. I'd really appreciate it. Good luck on your investing journey.